All right, in this training, we're going to talk about the 4 alternatives a business owner has for capital to grow their business or get through a tight pinch, and why DAC is the best source 80% of the time. So here's an example. You got a restaurant owner who wants to add a patio. They want to add more seats. You know, they say the average restaurant seat generates about $20,000 in revenue per year. So the more seats you have, the more revenue you're going to do. So this restaurant wants to add a patio. They're going to need 100,000. Well, maybe they are in a tight pinch and they need 100,000. Maybe they want to buy another location. Maybe they want to buy a new oven. Doesn't matter the use of funds. This is just an example. But let's say they need that 100,000. What are their 4 choices? Well, number 1, they've got their own savings, their own working capital. If they've got it, they use it, and we move on. We can't help them. Or maybe they have friends and family who are willing to give them the money, and the business owner is willing to deal with the pressure of owning a friend money and the guilt of taking a vacation while still owning that friend money. Or maybe they'll sell part of their company and bring on a partner through friends and family. But so those are 2 alternatives that business owner has, right? And then the third alternative is the big bank. Well, the big banks are great for some people. First of all, you have to have great credit. And if you have great credit and you want a big loan, they're really good. But here's your 4 ways a bank can help a business owner. Actually, there's 3 that they help a business owner. 1 is a credit card. Generally, as long as you have a good credit score of at least 670 or 700 above, you can get a credit card from the bank. But it's usually, $5,000, $10,000, $25,000. And if you're a business, you're not going to get a credit card unless you've been in business several years, right? The second way is what they call a revolving line of credit. It acts just like a credit card. It's just a higher balance or a higher approval amount. And that's approved by the bank themselves. Again, you generally have to have a 700 credit score or higher, which rules out over 80% of the business owners out there. And also you have to be in business for at least 1 or 2 years. And you have to be doing a lot of revenue. So that rules out, again, 80% of the businesses. The third way a bank could help is a bank loan. Now, there's 2 things about a big bank loan. Number 1, they want it to be at least $500,000 or more before they want to get into looking at it. And also they want collateral. So you have to put up your building there, as you see, either your house or your building or your property. So you need collateral to cover the loan. If you're borrowing $400,000, $500,000, you need to have $400,000 in equity available to pledge for your loan in case you don't pay it back. And again, they don't want to touch a loan under $500,000. It costs them too much time and aggravation in underwriting. And so these 3 things are your options for a business loan. Again, only about 20% of the business owners out there can utilize these. The 4th way, though, a bank can help, and they can help more with, is what they call a real estate loan. And it's really not a business loan. It's the business owner takes a personal loan against their house. So they've got home equity. They own a house that's worth $300,000. They only owe $150,000. They've got $150,000 in equity, and maybe the bank will say, "Hey, we'll give you $100,000 against that $150,000 in equity. Let's take a second mortgage." So it's really a real estate mortgage. But these are options for that business owner. So that's what a bank is going to help them with. And in many cases, those are significantly, if a business owner only needs $7,000 and they can get approved for a line of credit, good for them. They should. But if they need $100,000 in this case, they can't get a line of credit, they can't get a big business loan, and they don't have equity in their home, and they don't have good enough credit to qualify, which now we're down to 80% of the businesses in America can't qualify for what you're looking at right there. 80% cannot qualify. So where do they go? Well, that's where we come in, alternative business capital providers. Alternative capital providers are easy for businesses to get approved. They look at your cash flow more than your credit score. As long as you're doing at least $10,000 a monthly revenue, and at least you have a 500 credit score instead of a 700 like the big bank, 500, and you've been in business at least 4 months, then we can generally get you an offer. Now, here's the great thing. Because we represent all the top alternative providers, you already know alternative capital is a great source for this business owner. But now, which alternative capital provider should they go to? There's many of them. Well, we represent all the top credible ones. So that means you go through DAC, we're going to find you the best offer from all those sources. Why does that matter? Well, because provider A versus provider B versus provider C, and we've got over 40 of them. Some providers love restaurants, some love construction, some love people with low credit, some love people with great credit, some love people at $100,000 a monthly revenue, some love people at only $10,000 a monthly revenue. There's different specialties. We represent all of them. The business owner doesn't know this. They don't know which one to go talk to or even that they exist. So when you inform them that alternative capital exists, they get excited. When you then inform them that the approval process is easier than than big banks, they get really excited. They now know they have a choice. They now have peace of mind that they've got an opportunity. If they want to pursue it, they can get capital. And then when you let them know we represent all the top alternative providers, and by coming through DAC, we're going to find the best offer for them. The providers compete for that business because they know we represent many providers. So they're going to come with their best offer. They're going to do work underwriting and approving a deal. They're going to approve it with their best offer because they know we may select provider B versus provider A. So provider A is going to give us their best offer. So is provider Y. So is provider X, right? So we take all those providers, we get the best offer, and we present that to your client. Now, here's the other good news, is your client has a free application with no obligation to proceed. So we do all that work. The providers do all that work, and we don't charge anything to your client up front to do that. Your client can say no. So looking at the 4 options, if they've got savings, they don't need you, good, use your own money if they want to. Or friends and family will become partners or give them money, great. There's a whole different interest expense to that called guilt or concern about how you're being viewed by your friends and family while you're spending money until you've paid it back. Third way is big bank, which we know only about 20% can qualify to get approved there, but they should go there if they can. And then the fourth one is alternative capital, which is 80% of the business owners you know and see were their source. Alternative capital is their source, I should say, and then DAC is their source for alternative capital because one-stop, best offer, let the providers compete for the best offer, and free application, no obligation. You're positioned well. You're positioned well. And all you got to do is refer them to DAC and let our experts go to work. Thanks for being a part of this. Thanks for sharing the good news of alternative capital and DAC to business owners in your community, which includes the entire United States. Let's serve clients and be giants. Thank you all for watching.